Okay, so yesterday we spoke about the derecognition of an investment property, right? Okay, before we even got to the derecognition, we spoke about what investment property is, definition of an investment property. We said that it is a kind of asset that is held for rental to others, or is held for capital appreciation. Then we spoke about when or how do you go about recognizing it on your balance sheet. Then we say that it is when the recognition criteria, when the definition and the recognition criteria have been met. So the definition is that it's a type of asset that is either rented to others or is held for capital appreciation. We explained that. Then we said the recognition criteria, because it's an asset, it must comply with the two recognition criteria. That it is probable that economic benefit will flow to the entity, and secondly, that it's got a cost that can be measured reliably. All right, so that is what we discussed. And we also spoke about subsequent recognition or subsequent measurement. After you've initially recognized it on the balance sheet, what is subsequent we say that the standard says that we can either use the fair value model, or we can use the cost model, or sorry, the fair value model or the cost model. So if it's the cost model, then it is carried at cost less accumulated depreciation. And if it has the fair value model, then it is always carried at fair value, right? And we also spoke about the fact. So the investment property has got, there are two subsequent measure value, or it is cost model, fair value model or cost model. And we say fair value, it is not depreciation, right? But if it's on the cost model, then it's like the way we treat it for property, plants, and equipment. It's cost less accumulated depreciation. We explained the difference between fair value, revalued, and cost model. And I think we did an example where we had to calculate the depreciation, and then we passed a journal. Then we also spoke about the fact that now when you have recognized an investment property or any asset on the balance sheet, and you subsequently you've measured the asset, when the asset is no longer useful to the entity, that is no longer going to generate any economic benefits, or you dispose of the assets, then it means that we need to take it out of the balance sheet. And we spoke about that it's the opposite of recognition. So when you recognize an investment property, debit asset and credit bank, that's when you initially recognize it. But when you derecognize it, then it's the opposite, right? Because you are taking it out of the balance sheet. So you credit the investment property, and then you will debit a bank, and then you also credit or debit you debit loss on sale or profit on sale, depending on whether when you sold it, it was a profit or it was a loss. Then we spoke about the fact that in an instance whereby it also has to go through a disposal account, but we will discuss that later. So that was where we were before. Then we left there. Then we went to FAC2602. So today we are continuing. We are delving down into this investment property that we have already started discussing it. So we're going to continue to look at to understand it more, as to this investment property. How can we actually go about identifying the investment property better? If we are given a question, how are we going to be able to know that this is an investment property? So that's what we are going to be carrying on now. We'll look at a schematic or a decision diagram. On the diagram, you can see this helps a lot. Is the property held for sale in the ordinary course of business? So the first question asks you, is this property held for sale in the ordinary course of business? If a property is held for sale in the ordinary course of business, we know what it is, right? What is a property that is held for sale in the ordinary course of business? What is it called? We know that is inventory, right? If a property is held for sale in the ordinary course of business, that is inventory. So the first question you ask yourself is that, is this property held for sale in the ordinary course of business? If the answer is yes, then that means it is inventory. So we use what? IAS 2 to account for the inventory. If the answer is no, then we ask ourselves, is this property owner occupied? Owner occupied is the same as, is this property plants and equipment? So when they use the term owner occupied, they just equipment. So property plant and equipment means that property that you are occupying. You are not. It's not an investment property. Now is it an inventory? That is what we call owner occupied property. So owner occupied, if the answer is no, then or if you say the answer is yes, then you use the standard on property, plants and equipment, which is AS 16. Yeah. If the answer is no, then you ask yourself, is this property being constructed or developed for future use as an investment property? If the answer is yes, then the property is what? It's an investment property. Right? So remember what the definition of investment property is. It's used for, it's held for rental purposes, or it's held for capital appreciation. What capital appreciation means is that the value of the property will go up, and then I can sell it to make profit. Or rental means, okay, you know what rental is. I'll keep it and rent it to people to earn rental income. Good. So whenever you see a question, or whenever you read a question and you see property, you see a property, you go through this decision in your head. Is it property that is held for sale? If it is, that is inventory, right? If it's not, you ask yourself, is it property owner occupied? If it is, then you apply what? IAS 16, property, plants and equipment. If it's not, and it is property that is held for rental purposes or for capital appreciation, then you know what it is, an investment property. And if it's investment property, you ask yourself, which model am I going to use for this investment property? Is it the cost model or is it the fair value model? The question will tell you. So all these things, the question will make it clear. The question will make it clear. The question will tell you, so you have identified that it is not an inventory, it is not property, plants and equipment, therefore it is an investment property. If it's an investment property, then you ask yourself, is it going to be accounted for using the fair value model or the cost model? If it's the cost model, yes, cost less accumulated depreciation, right, to get your carrying amount. And you know what cost is? It's your purchase price plus transaction costs, import duties, transportation costs, and every cost that you incurred to bring the asset to its current condition is a cost, right? And then you depreciate it. So when you have depreciated, when you have the cost and you take away the accumulated depreciation, you are left with what? The carrying amount. You are left with the carrying amount. Good. So that is the cost model, or maybe the fair value model. So the fair value model is saying that you revalue the assets as often as possible, maybe every year. And when you fair value, when you decide to use the fair value model, that asset is not depreciated. It's not depreciated. When you decide to use a fair value model, that asset is not depreciated. So you must always remember, when I fair value an asset, I don't depreciate it, right? But when I revalue the asset, so there are three kinds of model. There is the cost model, there is the fair value model, then there is the revaluation model. So if we go to IAS 16, property, plants and equipment, it tells us that there are two models that they use there. When we're looking at property, plants and equipment, we're looking at the cost model and the revalued model, or the revaluation model. In both cases, you depreciate the asset. But when we talk of fair value, we don't depreciate it. We don't depreciate it. So when you read the question, you must read the question to understand which, I know it's an investment property, but which model am I using? Is it the fair value model or is it the cost model? Very, very important. Any questions? You can do a question on property, plants and equipment. You can do a question on investment property. You'll be able to do a question on inventory. You will know how to pass the journal entries. You know how to account for each of these types of assets in the balance sheet. You remember that inventory is valued at the lower of cost and net realizable value. We spoke about it yesterday. Property, plants and equipment is carried at costs less accumulated depreciation to get your carrying amount. Investment property. The investment property, often in a question, they will give you the fair value model. And the reason they will give you the fair value model is that the property, plants and equipment will be the cost model. So, of course, UNISA will want to test. They want to test all the models. So, if they know that property, plants and equipment is the cost model, then they want to know if you know how to account for fair value. So they will tell you that this investment property is actually being valued on the fair value model. So 95% of the time you get an investment property question that is based on the fair value model. Okay. So let's look at an example. I want you to read example 1 and let's discuss it. Read example 1 and let's discuss. Then read example 2 and let's read example 10 and let's discuss it. This will make you be able to identify an investment property when you see one. So let's read it and let's think about it. So number 1, ABC Limited has an office building. It has an office building. So when you are reading this question, you underline or you highlight office building. ABC Limited has an office building. You underline office building. The office building or the house has a small flatlet attached to the building. Right? So there's an office building. ABC Limited as a company has an office building. Attached to this building is a small flatlet. Right? And it's currently being rented out. So this small flatlet that is attached to the building is currently being rented out. Is this building an investment property or not? So it's not talking about the flat. So it's talking about this office building as a whole. Is it an investment property or not? Can someone try? Is this an investment property? You have an office building, and attached to this office building is a small flatlet, which is being rented out. Is this building an investment property? Is this office building, the whole of this office building, is it an investment property or not?
No, I don't think it is. I don't think it is an investment property because it is being occupied by the owners.
Okay, so you are saying that you don't think it is an investment property because it is being occupied by the owners. Okay, so it is being occupied by the owners. Oh, that is good. I think I'll give you 85%. That is good. So you don't think it's an investment property because it is the building is being occupied by the owners. Yeah. 85%. What about the fact that there's a small flatlet? Would that not change your mind in any way? What you have said is true. The building is being occupied by the owners or by the company, and therefore you don't think that it's an investment property because, like in this case, it's owner occupied, or it's a property, plants and equipment. That do you want to comment about the fact that there is a flatlet? Does the flatlet not play any?
It does, and I think that's what's confusing me. Yeah. I think it's a split issue. Like the
Okay.
portion that is being rented out, that's the part that is the investment property, and the part that is being owner occupied is obviously falling under PPE.
Yeah, excellent, excellent. So if you look at it, the building, the office building is actually being occupied, or is being used, for the production of income, right? So in other words, it is owner occupied, or it is property, plants, and equipment. The question says that it's a small flatlet. If you look at the fact that they specify that it's a small flatlet, means that it is not very significant, And when it comes to in this question about whether something is investment property or owner occupied, the percentage split is very, very important. So in this case, the fact that they have specified to us that it's a small flatlet means that it's just it is very small, and therefore we can conclude that the entire office building is not an investment property, but rather it is an owner occupied property. Does that make sense? So even though under normal circumstances, when you take a flatlet, right, that is rented to people as an investment property, but in this case, when we want to classify the property as a whole, it will not be an investment property because the portion of the rental is very small. It's very small. So therefore, we can say that this property is property, plants, and equipment, or it's owner occupied property and not an investment property. Good. I like that. Second question. ABC Limited owns a piece of land in Johannesburg. There is a possibility that this piece of land will be expropriated by the local council for the construction of a new road. ABC Limited's original intention was to buy this land. His intention with buying this land was to eventually construct its head offices on the stand. ABC Limited has decided to wait for the final decision of the local council before constructing the new offices on this land. So is this property an investment property or not? Is this land an investment property? We know what an investment property is, right? So let's apply it to the definition that we know. If you read the question, does this tell you whether this land is an investment property?
No, this is not investment property.
Why?
Because they say it was ABC Limited's original intention with buying the land was to eventually construct its head offices on the stand. So the intention was not to rent it out or anything like that.
Okay, good, excellent, 100%. So the intention was not to rent it out. Neither was the intention to hold it for capital appreciation. It was intended to be constructed. They intended it to construct a building on it to be used for as its head office, right? Good. So it is not, because the intention initially was to to construct a building on it which we're going to use as its head office. It is not an investment property. It's not an investment property. Yeah, because it was not held so that if the government decide to expropriate it, then they sell it to the government and make some money. No, that was not the original intention. The intention why they got this land was that in future they're going to construct their new head office on it. Yeah, and we know what a head office building, right? Head office building is what? Is building used in the production of income. So it's owner occupied, and it's not an investment property. It is not an investment property. That does this make sense so far? Any question, any concerns from anyone? Yeah, so you see, and that's why I was telling you that you need to be able to understand when it comes to accounting at this level, it's about applying the principles. It's not as easy as I know it, this is how it goes, and then no, it's you need to think about it. You need to apply the principle. The same question, somebody can be able to argue it out, and it can be an investment property, depend on your argument. You understand? If you're able to argue it out to convince us, then it can be an investment property. Yeah. So you need to be to apply. You need to be the standard. You need to understand the standard. You need to do questions. You need to apply your mind. The more questions you do, the more these things will be easier. You'll be able to identify them. Now let's look at number 3, which also applies to FAC2602 people, for those who are doing consolidations. So we have ABC Limited and all of its subsidiaries are occupying a building that ABC Limited owns, right? So both the parent and the subsidiary are all occupying a building, right? One building. The subsidiaries pay market-related rental to ABC Limited. So even though both parent and subsidiary are all occupying the same building, the building actually belongs to the parent, and therefore the subsidiary. So it means that the subsidiary has actually, the parent has actually rented part of the building to the subsidiary, and the subsidiary is paying rental to the parent. The building is occupied in the ratio of 30% to 70% by ABC Limited and its subsidiaries respectively. So in other words, 30% of the building is being occupied by the parent and 70% of the building is being occupied by the subsidiary. The subsidiary is occupying a bigger portion of this particular property. The intention is that ABC Limited and its subsidiaries will move to the new head offices once they have been constructed, and that the existing building will then be held until it can be sold for a market-related price. Is this building an investment property or not?
I think that in this instant, this is an investment property for ABC Limited because it is renting out majority of its space to one of its subsidiaries, and also there is an intention in the future to sell it at a market price, market related price.
Yeah, 100%. You are 100% right, correct. So because majority of this property is actually being rented out, right? We can therefore conclude that this is an investment property because why? And it's an investment property from whose perspective? From the parent or from the subsidiary?
From the parent.
From the parent. Good, from the parent, because it's the parent that has rented out the property to the subsidiary. So it is an investment property from the parent's point of view. Excellent. Yeah. So you can see that 70% of the building is being occupied by the subsidiary, 30% occupied by the parent. Majority of the building is actually has been rented out, and therefore from the perspective of the holding company, or the parent company, it is an investment property. Okay. So the guy doing FAC2602, are they here? Can I ask a follow-on question? Okay. So in the consolidated financial statements, how will this building be treated and why? In the consolidated financial statement, is this building still an investment property? And why? And why not? Anybody from FAC2602? Or even maybe you never know. Maybe anybody from FAC2601 can also answer. When I'm preparing the consolidated financial statements, what will this building be classified as? From the group perspective, What is this building and why? Is it still an investment property? The parent company has rented out a portion of its building to a subsidiary. So in the parent company's books, it is an investment property because it's rented it out and it complies with the definition of an investment property, which says a building that is either rented out or held for capital appreciation. But from a group perspective, this is not an investment. So from a group perspective, it is not an investment property. It is an owner-occupied property. UNISA will always test you on this particular thing. Every single time it will come in your exams. Where you have an instance where from a parent perspective, it is an investment property, but from a group perspective, it is what is owner occupied. Why is it owner occupied? Because remember, from a group perspective, you, the parent and the subsidiary are seen as one entity. So you are occupying your own property. So it is owner occupied. You get it? So from the group perspective, this property is owner occupied because when we talk of the group, the parent company and the subsidiary are one. They are one entity, right? And therefore, you are occupying your own property. Therefore, when you are preparing the consolidated financial statements, this is owner occupied property. It is treated as an owner occupied property. It only becomes an investment property when we are looking at it from the perspective of a parent company. The parent company. This question will come again. It will come many times. Many times. And you have to pass the journal entry to make adjustment to what the parent company has done, to what the consolidated financial statement should look like. Good. Cool. So this is everything we have discussed. Then let's also do this question. We'll read it, we'll analyze it, and then we will do it. So on 1 January 2018, B Limited acquired an investment property at 900,000. Right? So we have a company called B Limited. And then on the 1st of January 2018, it acquired an investment property. The question specifically tells us that it acquired an investment property. And at what value? 900,000. The full acquisition price was payable on 1 January 2018. So the full acquisition price, the price for this investment property was payable. They didn't say it was paid. They said it was payable. Payable. That means it became a liability on the 1st of January 2018. But as B Limited was experiencing cash flow problems, the seller agreed that 50% of the amount be paid immediately and the remainder to be paid at 1 July 2018. That means 6 months later. So half, that's 450,000 to be paid on the 1st of January 2018, and then the other half, the other 450,000 to be paid on the 1st of July 2018. 1st of July 2018, without charging any interest. Without charging any interest. This prolonged period exceeds normal credit terms. This prolonged period, the 6 months, they tell us that it exceeds normal credit terms. Is this statement important? Why is it important to us? This prolonged period exceeds normal credit terms. Because the standard tells us that if there is a transaction which exceeds normal credit terms, then we must take what? Interest into account. Okay. B Limited also paid transfer taxes of 55,000, while unproductive labor costs amounted to 25,000. You underline the word unproductive. UNISA will not just tell you unproductive for nothing. They just would have said while labor costs amounted to 25,000. In this case, they specifically said unproductive labor cost. What do we know about unproductive labor? Unproductive labor. Remember when we were dealing with property plants and equipment, we said that you include all the transaction prices except what? Normal or abnormal or wastage. Abnormal charges you don't include, you exclude those ones. So for a normal labor cost, we include, but abnormal labor cost, we don't include it. Or wastage time or idle time, we don't include those ones. So when you read the unproductive labor cost, it should be something should be ringing a bell somewhere. It's 25,000. A discount rate of 12% per annum before tax, compounded annually, is regarded as appropriate. So we should use a discount rate of 12% per annum, compounded annually, to be used in this calculation. And the question is, calculate the amount that the investment property will be measured in the financial statements of B Limited. I think so. Yeah. Yeah. So let's analyze this question. On the 1st of January, B Limited acquired an investment property for 900,000. The full price is payable on the 1st of January 2018. But B Limited didn't have the money, so it decided to pay the other half 6 months later, right? And we are told that B Limited paid transfer taxes of 55,000. Transfer taxes. What do we know about the cost of an item? All costs or all charges that were incurred to bring the asset to its current condition should be included as the cost, excluding abnormal wastage or taxes that are going to be refundable. Yeah, those are excluded. But otherwise, every other cost that is incurred to bring the asset to its current condition must be included, right? Then they said we must use a discount rate of 12%. Why? What are we using this discount rate for? Why are this question giving us a discount rate to be used for what? We have been given a discount rate in this question for what?
To calculate discount.
To calculate discount. Which discount? Is there some hidden discount that we don't know?
No, actually, there isn't. It doesn't say anywhere that we were given a discount. Okay. So yeah, I don't know why there's a discount rate.
Okay. Have you learned about what is called a present value? Have you ever met the term present value?
Yes, I have in one of my other modules. Yes.
Okay, you have. Which module is that?
It's financial management.
Financial management. Good. All right. Cool. So that is fine. All right. Excellent. Okay. All right. So whenever you read a question and the question has got a discount rate in it, then alarm bells should be ringing. You should be using it somewhere, somehow, because when you read the question, said the seller agreed that 50% of the amount be paid immediately and the remainder at 1 July 2018. So 50% of the amount is going to be paid now. The remainder is going to be paid in 6 months' time. But whenever you are calculating the cost of an item, right, or the price or the value of something, the value needs to be calculated it needs to be calculated now, present value, now. So if I'm going to be paying an amount in 6 months' time, I have to calculate, I have to discount that amount I'm going to be paying in 6 months' time I need to bring it back to the present value. You understand? It talks about the time value of money. Remember, we say that 1,000 today or 1,000 today is not the same 1,000 tomorrow. Or 1,000 rand today is not going to be the same value 1,000 rand 5 years time. 10,000 rand today is not the same as 10,000. It's not going to be the same as 10,000 rand 20 years from now. 20 years from now, 10,000 will be no money. 20 years from now, 10,000 will be like 500 rand because of inflation, right? So we have what is called a time value of money. Money has got, there's a time that is attached to the value of money. It's called a time value of money. So money today is not the same as the value of that money tomorrow. If I give you 10,000 rand now, in 20 years time, that 10,000 rand it is going to be a different value. Like it's going to worth maybe 500 rand equivalent because of inflation. Because of inflation. So whenever you read a question and the question is that some payment whatever is going to be done at a later stage. Like in this question, they tell us that 50% is going to be paid now, then the other 50 is going to be paid in 6 months' time. It means we have a problem. 6 months' time, 450,000 is going to be paid, right? But we want to know the value now, today, as of today. We don't want to wait 6 months' time. We want to know the value of this investment property today. So what we do is that the term used is called discounting. We discount, or we say that what is 450,000 rand in 6 months' time, what is its value today? And for us to be able to calculate the value today of 450,000 6 months, we need what? An interest rate to discount it. So any amount, if you want to calculate the discount rate, it is the amount divided if any amount. If you want to calculate the present value, it is the amount divided by the interest rate. The amount divided by the interest rate will give you the present value. Present value is equals to, please write, I forgot to write it in your notes. Write it somewhere. Present value is equals to the payment or the amount divided by the interest rate will give you the present value. Don't forget that. But you will know it at the back of your hand, because you will see so many times, or you do so many questions, especially if you do management accounting, you will do it a lot. You always discounting, you always, calculate the present value of something. Okay, good. So let's go to the solution. So solution says we must find what? The cost of the investment property. So the cost of the investment property is as follows. The cost paid in 1 January 2018 was 950%, right? Because they told us that now, on the 1st of January, which is now, it was we paid 450,000, which is 900,000 times 50%, half, right? So we got 450. Then we calculate what? The present value of 450,000 to be paid 6 months from now. We bring that value here, and if you use your financial calculator. You use a financial calculator, you clear your memories. You say N, you compute 1. I, you say 6. Future value is 450,000, you compute present value, and it gives you the answer. If you don't want to do that, if you don't want to use your financial calculator, then you have to do it manually. And the manually is going to be I can't even remember the formula. I'll tell you, I'll find the formula and tell you. But normally we use the financial calculator to say N equals 1, I equals 6, future value equals 450. You compute present value, and it gives you the answer 425528. So you can see that in 6 months' time, you are paying 450,000. But this 450,000 is equivalent to what? 424,528. It's a lesser amount today. That means in 6 months' time, this money will have devalued in value because of inflation. Why do we have? And now let's look at the parameters to use in our financial calculator. Future value is 450 because that is what? The future value of this amount. That is in 6 months' time, which is the future value, is 450,000, right? Your discount rate is 6, right? And I think that is where the trick is. How did I get 6? Because they told us in the question that a discount rate of 12% per annum. So per annum, the discount rate is 12% per annum. So in 6 months' time, what would the interest rate be? Because 6 months is half, or it's how do I say? It's twice. Two of 6 months will give you will give you 1 year. You divide your interest rate by 2. If you want a formula for that, you divide your interest rate 12 divided by the number of periods in a year. So in this case, it is how many 6 months periods are in a year? 2. So you divide by 2, then you got 6. If let's say this question, we're going to pay the extra 450 every quarter. How many quarters are in a year? Yeah, there are how many? 4 quarters in a year, right? 4 quarters in a year. So you say 12 divided by 4, and you get 3%. If they tell us that you are going to pay the extra amount of 450 not in 6 months time, but like whatever period that they tell you, you divide that period. How many periods are in a year? So that is it is the interest rate divided by the number of periods will give you your interest rate. So always bear in mind your interest rate must be the same as the period that the payments are falling into. In other words, in this case, they tell us that you are going to be paying in 6 months' time, right? So because I know that there are 2 6 months in a year, I divide by 2 to get 6%. If the question had told me that you are going to be paying every quarter or every quarter, you ask yourself, how many quarters are in a year? There are 4 quarters. It's going to be 12 divided by 4 to get 3. If the question tells me you are going to be paying every 2 months, how many 2-month periods are in a year? There are 6, right? So it will be 12 divided by 6 to get 2%. So you must match your interest rate to the payment period. Very important. Right?
Hi, Gordon. Sorry, can I
Yes.
just ask? So with the N, you said it's the number of years.
No, the number of periods in a year.
The number of periods in a year.
Number of periods in a year. Yes.
Oh, okay. And so shouldn't we also maybe be dividing that also, like considering the fact that it's not just per annum,
sorry.
like there's also
yeah. Sorry, I made a mistake. N is not the number of periods in a year. So N is the number of periods that you are going to be paying for. So in this case, you have a timeline, right? 1, and then you are going to be moving. You are discounting in from 6 months up to the present period. So you are going to what? You are going to jump like 1 step from the 6 months. It's just one period, right? So what I was trying to calculate is why the I is 6 and not 12. right? But in terms of the end tells you the number of payments you are going to be making, basically. Yeah.
Oh,
The number
okay.
of payments you are going to be. So N is the number of payments you are going to be making. Your I is your interest rate, which has been linked to the number of payments, right? Your future value is the 450,000, which is the final amount, and your present value is what you it's your X, what you don't know.
Okay.
Yeah. What you don't know. Does that make sense?
Yes, it does make sense.
Okay.
Thank you.
All right. Anyone who doesn't, who's a bit confused? Yeah. So whenever you have to calculate, so I'll just repeat. Whenever you have to calculate the present value of something, that's how you do it. And why am I calculating the present value? I'm calculating the present value because when I'm measuring the cost of something, it needs to be the cost needs to be accounted for at a particular point at P0, at this point in time. So if something is going to be done in 6 months' time, or in a year's time, or 2 years' time, 4 years' time, I need to bring that payment back to the present time. And how do I do it? I use a method called discounting. And how do I discount? I said, what is my N? My N is just one payment. My I is the number of periods in that particular year. So in this case, I'm going to pay every 6 months. They've given me the interest rate per annum. So I pay year. So if they've given me the interest rate per year and I'm going to be paying in 6 months' time, I need to divide by 2 because there are 6 monthly payments. There are 2 6 monthly payments in a year. 6 months, right? So divided by 2 to get 6. My future value is 45,000, and I compute my present value. Then I get 425,528. It's very important that you write the parameters down. We mark it. So even if you get the answer wrong, the fact that you said N is 1, I is 6, fair value 450, you get marks for that. You get marks for that. So in an exam, what we mark is the parameters. What is your N? What is your I? What is your FV? Right? We don't mark the answer. We don't mark the 425,528. If you get it wrong, it doesn't matter. So what is the trick? Tamsack a number, but you must get your N is this, I is this, F is this right. That is what we mark. We don't mark the answer, the 420. We don't mark the 425,528. Do you understand? So because in an accounting question, you are always pressed for time, right? Don't worry yourself trying to get it right. So I say, okay, N it is 1, I is 6, FV is 450, compute. Then I just write maybe 300,000, or maybe don't make it a rounded number. Make it maybe 327,000 or something. That is the exam technique. Because I promise you, if 400 people are writing these exams, we are going to get 400 people giving us a different answer. Every single one of you give us a different answer. So what is the point? Write an answer there and just move on. But make sure that what is in bracket is there. Your N, your I, your future value. Because then it tells us that you know what you are doing. Okay, then transfer taxes, 55,000. They told us in the question that transfer taxes is 55,000. You know, for me to calculate the cost, I need what? I need to include all the costs that I incurred to bring the asset into its current condition, right? Unproductive labor is unproductive labor. The standard in IAS 40 tells us that we exclude unproductive labor cost. But you need to write unproductive. If you don't write unproductive labor, we don't mark it. You get it wrong. We need to know that you've actually written unproductive. So don't just ignore it. Write it there and write 0, and you get 2 marks. Don't just leave because it's unproductive labor cost is not included, so I leave it out. No, you write it and you show us that it's 0, then you get a full marks. If you leave it out, you will fail. You need to bring it in. You need to write it and write 0. Does that make sense? And then the total amount, the 929,528. If you are pressed for time, don't worry yourself trying to total up, trying to make sure that everything is correct, because chances are you are wrong anyway. So just write a number there, 800,000, and move on. And if you do that, you probably get about 99%, because this answer of 424,528 will carry maybe half a mark. And then your N, your I, your F will carry about 3 marks. So each one will get a tick. Lauren, please ask me.
She said, will I be wrong if I calculate the present value factor? That is 1 divided by, in brackets, 1 plus 0.12 divided by 2 equals to 0.9412.
You will not be wrong, just that you may be wasting time. That is the thing. And in any case, UNISA will give you the factor. The exams will give you the factor. If they want you to use the factor, they will give you the factor. If they want you to use your financial calculator, you'll be silent. So when they are silent, then you know you must use your financial calculator. But when they give you a factor, then you must use the factor. So if they don't give you a factor and you go and use a factor, you'll be wasting a lot of time. But the person using a financial calculator will be able to, within seconds, 30 seconds, they are done. Well, they've written down and they are moving on. You will still be 2 minutes, 3 minutes trying to still using the fact calculating, making sure things, your formula is right and so on and so forth. Right. So if they are silent, use your financial calculator. But if they tell you that you use a factor, and of course, then they'll give you the factor, or they'll give you the formula to use, whichever way, according to what the question wants. But I'm just giving you the tricks when we are marking the things that I mean, I've been marking for some time now, and this is how we mark. This is how we mark. Okay, good. Is everyone clear on the principle? It's very easy. Cost is the cash price, 450,000, present value of whatever amount I'm going to be settling in the future, and then my transfer taxes, and then I get what? Then unproductive labor, very important. You need to write it and indicate that it is 0 before you can get the full marks. Does that make sense? Any questions? Guys, just want to let you know that there is an assessment form that was sent. Please, it's very important that you complete this assessment form, right? It's very, very important. I complete the assessment form and hand it in. Very, very, very important. Please, it's quite urgent as well. Okay, cool. Does everyone understand it? Will you be able to get because we're going to be doing FAC2602 in about the next maybe 10 minutes. Does everyone understand this? Will you be able to calculate the cost of an investment property? Will you be able to identify what an investment property is based on the definition and the recognition criteria? Will you be able to calculate the cost? Okay, so it's not difficult. Let's do this question. This is the last question we'll do. So fair value model for measuring investment property, right? C Limited owns an office building that is let to Z Limited. So C Limited is letting an office building to Z Limited. So already, as you are reading this question, you are thinking about what investment property. The fact that you saw the word "let," you are thinking about investment property, right? And you know that C is the lessor and the Z is the lessee. Okay, And under an operating lease agreement, as the building is used to generate rental income, it can be classified as an investment property in terms of IS 40. Okay. C Limited has adopted the fair value model as its accounting policy for measuring investment property. And that's exactly how UNISA will give you. The C Limited has adopted the fair value model. They will tell you what accounting policy that the company has adopted. Are they using the cost model? Are they using the fair value model? These are the only two models that we use in an investment property, right? Good. The building has a useful life of 40 years. This is quite tricky. Huh? They tell us that it's a fair value model, and yet they've given us the useful life of 40 years. So as you are reading, you're asking yourself, why is the accounting policy for fair value, and yet they've given me a useful life of 40 years? What am I using it for? Because if it's a fair value, I don't need depreciation. Why have they given me 40 years? What am I using this 40 years for? So you put it somewhere at the back of your mind while you carry on reading, right? Good. The following fair value apply. On acquisition date, which is on the 1st of January 2017, the cost was 400,000. 31st December 2017, that is at the end of the year, the cost was 600,000. 31st December 2018, the building was, now the fair value has come down from 600 to 500,000. On 1 January 2017, C Limited recognized the building at a cost of 400,000. Okay, it's already there. On 1 January 2020, C Limited recognized the building at a cost of 400,000. Good. On 31st December 2017, C Limited had to remeasure the building at fair value. So on acquisition date, when C Limited acquired Z Limited, the cost of this building was 400,000. But after a year, on the 31st of December 2017, C Limited remeasured the building at fair value, and the fair value was what? 600,000. So the building has moved from 400,000 to 600,000 under the fair value model, right? The remeasurement is recognized in the profit or loss section of the statement of profit or loss and other comprehensive income, right? Good. What is required? Okay, so the required is that prepare the journal entries to account for this investment property from the date of acquisition until the 31st of December 2018. Prepare the journal entries to account for the prepare the journal entry to account for this investment property, right? Good. Cool. So let's see. On what have they left out? Maybe they should have put a journal entry to initially recognize the property, right? To say debit investment property 400,000 and credit maybe bank of 400,000. That is when they initially recognize the investment property, right? Because they tell us that the standard tells us that initially the investment property is recognized what at cost, right? And then subsequently it's either the fair value model or the cost model. So I think maybe the journal entry that they left out was that to have recognized the initial value of 400,000. But they started the journal entry from the 31st of December. So anyway, so investment property, statement of financial position is 200,000. How did I get 200,000? The value was 400,000. It was revalued to 600,000. So from 600 minus 400 is 200,000. Then credit what? Fair value adjustment. Where does the fair value adjustment go? To profit and loss. This is very, very important. When you have an investment property and you revalue the property, the fair value adjustment goes to other comprehensive income. It goes to other comprehensive income. Sorry. I'm making. They tell us that their accounting policy, they measure The remeasurement is recognized in profit or loss, or in the statement of profit and loss. Okay, so that's what they told us. So they told us that for this particular company, when they revalue, when they have a revaluation, the credit portion goes to profit and loss. It goes to profit and loss. It goes to profit and loss. So debit investment property 200,000, credit fair value adjustment 200,000. Okay. No depreciation is provided on investment property measured at fair value. Okay. Then on 31st December 2018, C Limited once again remeasured investment property to fair value, with the loss being recognized in the profit or loss section of the statement of profit or loss under comprehensive income. So fair value in 31st December, remember the asset came down from 600 to 500, right? So when they fair value it, it moved from 600,000 to 500,000. So now, what is the journal entry? Now it means that we need to credit investment property because investment property has come down. So debit credit investment property of 100,000 and debit fair value adjustment 100,000. Does everyone understand the journal entry? I'm taking a bit longer when we do the FAC2601 because the fundamental principles of FAC2601 also apply to FAC2602. So by anyone who is doing FAC2602 will also benefit, because remember, when we go to FAC2602, prior knowledge is assumed. They assume that you know all these things already. They don't teach it again. Now they just start applying consolidation principles, assuming that you know this thing already. So that's why I take a bit longer when I'm doing the 2601, because they assume that you know this already. And one thing you must take from this particular example, that just know, when I revalue an asset under the property, plants and equipment, the revaluation goes to other comprehensive income. But when I'm dealing with an investment property, the revaluation, the corresponding leg goes to profit and loss. Very, very crucial, very important, and it's got tax implications. It goes to profit and loss. So what the standard is trying to say is that investment property is like close to close to the, or it's measured the real performance of the company compared to when you actually revalue an asset. So they want so they're saying that fair value, should actually go into profit and loss. Because fair value, it's I don't even know how to explain it. It's current, it's current market prices. So you are more likely to be able to if you say something is fair valued, it's current market prices, and therefore you are more likely to get your money's worth, for that particular item than when a property is just revalued. So they think that fair value should rather be in a profit and loss, and then revaluation should go to the OCI. Do you understand why investment property? If you look at 31st December 20X7, it was we said debit investment property because the property has gone up, and property goes up with a debit balance. So debit property, plants and equipment, debit investment property 200,000. Where does the corresponding leg go? It goes to profit and loss. It goes to profit and loss. Fair value adjustment goes to profit and loss. If this property was property, plants and equipment, and this property was revalued, not fair value, but revalued property, plant, and equipment, it will have been debit PPE 200,000, credit OCI, other comprehensive income 200,000. It wouldn't be credit profit and loss. It would be credit other comprehensive income. If this property was property, plants and equipment, but because it's an investment property, the credit goes to profit and loss. That's the corresponding entry. On the 31st December 2017, when the property value went down, guess what? because an asset has gone down, we credited the investment property of 100,000 and we debited profit and loss of 100,000. That's fair value adjustment. Fair value adjustment. Does this make sense? So basically, we have come to an end of. I'll leave the other question for you to do on your own. We have come to the end of investment property. Very, very important, very crucial. We are on our way to leases, FAC16, right? If there's no question, can I switch on to FAC2602? Any questions? When it comes to the present value calculation, you will see a lot of it. So don't panic. You will do a lot. You will do a lot. You will get used to it, because almost every question in property plants and equipment, you will get where you need to calculate the present value. You will get it. So you will do so many examples that it will become second nature. I promise you. So don't panic. You will know like this. NI future value, compute present value. Sometimes you may have to compute the payment depending on. Right? Cool. Okay. So last week I said you must go and think about the elimination journal, the initial elimination journal entry when we are doing FAC2602, the debit share capital, and I mean the debit share capital and credit investment. Did you go and study it? Did you understand it? Any concerns? Any issues on that? Even before we even go into that, let me go a step back. First of all, why are we preparing consolidated financial statements? Who can tell me why are we preparing consolidated financial statements?
Okay, so it's to any intragroup transactions.
Sorry, to
eliminate any intragroup transactions.
Yes, it is. Is that the main reason why we prepare consolidated financial statements? First of all, even like prepare consolidated why are we preparing for consolidated financial statement in the first place? I mean, we're taking it like basics, right? We're going back to the basics, right? Because it's very important that at lectures you actually get to understand the principles. Why? Who told us to prepare consolidated financial statement? Why are we preparing financial? What circumstances do we have to prepare financial statement? What led to us even in the first place to prepare consolidated financial statement? What led us to this consolidated financial statement? Because before this, right from high school to your first year, all you knew is that you have a company and then you prepare your company's financial statement. Now you come to tertiary, we come to second year, and like we are learning how to prepare consolidated financial statement. What changed? What brought about this whole consolidated financial statement? Anybody? What happened? Then all of a sudden they said, accountants, you must now start preparing consolidated financial statement. What changed?
I think, well, and this is just my thinking.
Yes.
I think it's because now there's subsidiaries, like there's more than one company owned by another company. So that's why you would have to have all those different financial statements consolidated into one to see what the whole group is what the whole group's financial position looks like.
Excellent. You 102%. That is excellent. That is it. That is the main purpose of preparing a consolidated financial statement, because companies decided that they were not just going to stick on their own. They were going to acquire other companies and get bigger. And that's what companies do these days. In order to grow their revenue, in order for them to be able to grow their business, they said, no, let's acquire other companies as well, you know, so for us to be bigger and bigger and bigger. And because they went to acquire other companies, those other companies became what? Part of them. Like they became like their buddies, you know, their friends. They can do transactions together, you know. They can even collude to do things that are not legal, you know. So, you know, and remember in accounting, what we intend to do is that we tend to do what? We have the substance over the form. We don't just think about the legal form, we think about the substance. What is this? If I am a company and I've acquired other companies, right? In a sense, what have I done? I'm one, right? Because that company that I acquired, we are one. We do things together. We have meshed together. We have become one. Sometimes we even decide to change our accounting systems, right? So that all our accounting systems are the same. We decide to be in the same building so that there are synergies. You know, we even decide that if maybe every company had their own HR department, when we merge together, we decide even to have one HR department. You know, so we are like one. You know, even sometimes if one is here in South Africa and the another one is in the UK, it's the United Kingdom, we can even decide to lend them some money. Yeah, they will borrow money from us. We will lend them money. So we trade with each other. We are one. When one hand or one subsidiary is not doing so well, the parent company can decide to lend them money, you know, to bail them out. You know, so we are one entity. So if we are one entity, therefore then therefore we are one. So therefore we need to prepare a consolidated financial statement to show that we are one. So all our assets are together, all our liabilities are together, our balance sheet are together, income statement are together, statement of changes in equity are together. But that does not mean that the holding company or the parent company, the subsidiary, do not prepare their own financial statement. They do. They do. So the parent company, it continues as usual. It prepares its own financial statements, right? And the subsidiary also prepares its own financial statement. The consolidated financial statement is in addition to their own financial statement that they prepare. Do you understand? So whenever you look at a set of annual report, you see company's financial statement and consolidated financial statement. That means the parent has prepared its own financial statement with its own income statement, balance sheet, statement of change in equity, cash flow, whatever. Then in addition to that, they also prepare what? Consolidated financial statement to put together all the subsidiaries that they control. And each subsidiary also, they prepare their own financial statement, but the subsidiary cannot prepare a consolidated financial statement, right? It is the parent that prepares the consolidated because the parent has control. The one who has got control prepares the consolidated financial statement. Do you understand this? So it's not like a subsidiary is going to prepare a consolidated financial statement. No, a subsidiary does not prepare. A subsidiary prepares a consolidated financial statement of a subsidiary that subsidiary controls. Do you understand? So if I'm a subsidiary, right, I'm a subsidiary and I control a company below me, I need to prepare a consolidated financial statement. But if the standard says that if that company a subsidiary that I control is part of the group and we have a parent company which is higher than us, then I can decide as a subsidiary not to prepare a consolidated financial statement. Because why? Because my parent, the ultimate parent company, will prepare a consolidated financial statement. So that is the only time that as a subsidiary I am exempted from preparing a consolidated financial statement. I'll repeat. If I am a subsidiary, right, I do not prepare, under normal circumstances, I don't prepare a consolidated financial statement. I just prepare my own financial statement. But if I happen to have me a subsidiary, I happen to have a company that I control, even though I'm a subsidiary, I also control a company, then I must prepare a consolidated financial statement. But if that company that I control right, happens to also to be controlled by my parent company, then I can be exempted as a from preparing consolidated financial statement. Why? Because my parent is going to prepare the consolidated financial statement, which comprises me and the one that I control. Because the parent also controls me and also controls the one that I control. Does that make sense? Does that make sense? Or must I next time draw diagrams? Does that make sense?
I think I was understanding, and it's just one subsidiary to the parent, but if the subsidiary also controls one,
Yeah.
I think that there it confuses me a bit.
Oh, is it?
Yeah,
No,
yeah.
it mustn't confuse, because that is how it works in real life. So in real
Yes.
life, let me give you an example.
Yeah.
Standard Bank.
Mm-hmm.
Standard Bank, I think, owns Liberty. Liberty has also got other, I cannot even remember which one it has. So Liberty is a subsidiary of Standard Bank, right? Liberty also has got its own subsidiaries, right? Like if argument, let's say Liberty owns
Yes.
Stanley, right? Stanley. So Liberty must prepare the consolidated financial statement, which comprises Liberty itself and Stanley. But if Standard Bank controls Liberty and controls Liberty and also controls Stanley, then Standard Bank must prepare the consolidated financial statement, which comprises Liberty and Stanley.
Okay, I hear you.
Yeah.
And it doesn't happen that maybe, let's say, Stanley is, although it's controlled by Liberty, it is not part of Standard Bank. It doesn't happen that way, that a subsidiary could have its own business that's not part of the bigger group. Or it seldom happens.
Yeah. So a subsidiary has its own one that is not. That is a tricky one, but yeah, it happens. So more often than not, the subsidiary because Standard Bank controls the subsidiary, right? Whatever the subsidiary has, right, more often will also be, because the subsidiary will get its income and whatever from this one. Meanwhile, Standard Bank also controls you, so I must also include whoever you control as part of my consolidated financial statement. So normally what we do is that they do a bottom-up approach. So they start from the bottom. So Stanley, Liberty will consolidate Stanley into it, right? And once Liberty is done with their consolidation, then the Standard Bank will consolidate them into Standard Bank's one.
Okay.
Yeah. So one prepares it. So we do at VET, we used to have questions like that, where you have like a whole chain of subsidiaries, and then when you're preparing the consolidated finance, you actually start from the bottom, the one that is actually below. So you prepare the below one, then come to the middle, then come to the top, then come to the very top, like that. Yeah. But this, yeah. So in practice, that's how it works. They start from the one which are the bottom. The one, the bottom, everyone is consolidating. The ultimate holding company now puts everything together and prepare a major, big, gigantic consolidated financial statement, which comprises everyone in the group, because they started from the bottom, consolidating this, consolidating that, everything together. And remember, even what makes it more complex, the fact that what we have just discussed is a vertical group, but you have fellow subsidiaries as well that is going horizontal, right? So it does really get complicated. But of course, these days we have systems in place that does consolidations. But it's very important for you to understand, as an accountant, to understand how it works. What are we doing? Because you can't just you can't just rely on the systems all the time. You must understand if the system is at fault, you must be able to, because remember, a system is as good as what you put inside it, right? So you as an accountant must be able to know what goes into it. Right. Yeah. So it can get very complex, but there are systems and the automated system that does these things in real life. Just that you must understand it. Okay. Good. So that is how it works. So now you know that the parent company also prepares its own financial statements and yada. So what we call a pro forma journal entry, right? This pro forma journal entry is just for the consolidations. It's just for the consolidations, right? So a pro forma journal entry get passed every year, the same thing, over and over again, the same thing, right? So it doesn't change the company itself. The pro forma journal entry is just for the consolidations. Each subsidiary, each parent prepares their own financial statements, but the pro forma journal entry is for consolidations. So as we going along with this whole consolidation thing, don't think that the pro forma journal entry is something they just they just forget about their own financial statement and then they just prepare. No. The consolidation is something different altogether. It's something different. They all have their own individual financial statement, but then the pro forma journal entries are prepared just for the consolidations. Just for the consolidations. Good. Does that make sense? Cool. All right. Then another principle is that often, right, what happens in real life is that Liberty will be there, right? They will be maybe they may be operating for the last 50 years. Then all of a sudden, Standard Bank decide to buy or to go and acquire Liberty, right? On the day that it acquired Liberty, you must remember Liberty has been in operation for 50 years. Then Standard Bank comes to acquire this company. So that means on the day of acquisition, Liberty has its own share capital. It has its own retained earnings. It has its own non-distributable reserve. It has its own everything because it's already a company that is already in operation, right? Then before Standard Bank came to acquire it. When we are preparing the consolidated financial statements, we don't take into account the income that existed when Standard Bank came to acquire Liberty. Remember, the whole purpose of consolidated financial statement is to show the users of the financial statement that from the time that Standard Bank acquired Liberty, this is how much as a group we have been able to earn or to make. Don't go and include the amount that is already sitting there when you came to acquire it. It doesn't make sense. It doesn't show the performance of the business, right? It doesn't show the performance because the financial statement should be able to show the performance, how much you have been able to earn ever since this acquisition took place. So the income, the retained earnings and whatever that existed when Standard Bank came to acquire Liberty is not included in the consolidated financial statements. Do you understand this principle? Very, very important. So there will be retained earnings at Liberty already. With Liberty will have their own retained earnings and their share capital and whatever. Those things that were already there. Going forward, I mean, at the date of acquisition, we don't take them into account. Because remember, it will be very misleading for us to include everything that Liberty had plus what Standard Bank had, and we say that, okay, this is our consolidated financial statement. It doesn't make sense. Why doesn't it make sense? It doesn't make sense because you, Standard Bank, you did not take part when Liberty was earning all this income for the past 50 years. You were not there. You hadn't acquired Liberty. We only start accounting for the consolidated financial statement from the time that Standard Bank acquired it and moving forward. So that a user will be able to look at the consolidated financial statement and say, oh, okay, wow. So this is the accumulated income that you as Standard Bank have been able to help Liberty for them to be able to earn. Does this make sense? I know I'm going deeper, but that is how it is. Does this make sense? And that is also the reason why that when we do the main elimination journal entry, we debit the retained earnings and we debit the share capital, because those things are not part of the group. They already existed when Standard Bank came to acquire Liberty. So we need to reverse them. They are not part of the group. They are not part of the group earnings. My students are quiet. I'm worried. Is it complicated?
I think for me it is, but maybe, with time and getting to understand it.
Where am I losing you? Which aspect is a bit confusing?
No, it's actually not confusing. It's just that I generally would have expected that, if I acquire a business, I obviously, but let's talk like layman. Let's say I buy a business that's like worth R1 million, right?
Yes.
Yeah, okay. And it says it has a revenue potential of, I don't know how the revenue would I guess the million would. Okay, let's say also it has a revenue potential of like say 2 million. All right.
Okay.
Yeah. Don't I need to like declare that somewhere, or am I just gonna say I'm starting off with a business that's worth $1 million, and then after a month I start then assessing the progress I'm making with this business without
if you have I think that if you have a business, right, that you have acquired, you said for $1 million, and you say that it has a potential to give me another extra like 2 million.
Yes.
Right. And then you are saying that shouldn't you include that 2 million as part of your consolidated financial statement?
I don't know. Okay, of course I can't, because it's the potential. Yeah, okay, yes. No, I get you. Because only once I start realizing the revenue, would I then start putting, okay, no, I get you.
Exactly. Exactly. Okay. And then the tricky aspect here is that when you are preparing, remember, when before you came to buy this business already had some income, right? It had income. So imagine that when you came and then it had income, did you take part in production of that income? Did you take part? Were you there when I was earning?
No, I didn't. Of course, yeah.
You were not.
Yeah.
You were not. So if you were not, you can. When we are preparing the consolidated financial statement, you cannot include the profit that I earn on my own to say, because if you include it as part of the consolidated financial statement, it tells any user that, oh, okay, so you guys are so good, you and your holding company, you earn all this income, which is not right. It's not correct.
Okay, so basically, I'm starting on a zero, although it has been an existing business, but on my books it will show a zero. Yes. Okay.
Yes. All right. Yes. Okay. That's what it's about. You are starting on a zero plate. You are starting from zero.
Okay.
You are starting from zero. So whatever that you came to meet, take it out. Reverse out your share capital. Reverse out retained earnings, because they are not yours.
Okay.
They don't belong to it doesn't form part of the consolidated financial statement. It doesn't. So take it out. It's not yours. You didn't take part in it. And I think today I just decided to go the fundamentals to make you understand, because I'm telling you, many people don't understand. They will get to 4th year without really, then they will start struggling and say, I'm failing. Because the fundamental was not there. They didn't understand. So when I joined the company, whatever income that this company has accumulated, I was not part of it. It was not based on my decision. It was not based on my management. It was not based on, and I didn't contribute a cent to this. So it gets eliminated. And that's what we call what at acquisition journal entry. So at acquisition journal entry, it says that what because you are not part of this, reverse them out. Start on a clean slate. So you will see when we start doing questions, all the retained earnings that we bring into the consolidated financial statement are the retained earnings post acquisition. We don't include anything pre-acquisition because that pre-acquisition earnings, we did not take part in it. It's not ours. It belongs to the subsidiary.
Gordon,
Yes.
there's a question on the chat. Maybe Devone can just read it.
Okay.
Is there a question? Over to you, Devone.
Devon.
I just want to find out what is the journal entries before acquisition. So the journal entries in terms of retained earnings and share capital in the event that the company has been trading before you acquired your holding in them.
Okay. Cool. Good. Good question. So before the parent came to acquire, right? The subsidiary was trading on its own. They were passing their journal entries. So at the end of the day, or they will make journal entries, or they will account for their income, their expenses, their whatever, and then at the end of the year, they'll get what? A net profit, right? In the income statement. This net profit will be swept into the retained earnings to increase your retained earnings every year, right? So that's what happens. So at every year, end of the year, you pass an entry to take out your net income into retained earnings, right? So you debit net income and you credit retained earnings every year. As you are earning income, you sweep it to the retained earnings. As you are earning income, you sweep it to the retained earnings. All your assets are there, all your liabilities are there. So your balance sheet remains intact because you are in the production of income, you are doing your own thing. There's no one who has told you that it wants to acquire you. So you are performing as usual, right? Then all of a sudden, one day, a big company comes and say, you know what, we are taking you over, or we are going to acquire you. You are going to be a subsidiary, and then all the shareholders of your subsidiary have agreed that the acquisition must now must carry on, right? So at that, so there's an acquisition date. So in every company, on the day the subsidiary will prepare a financial statement, right, up to the acquisition date. It doesn't have to be at the end of their financial year. If acquisition says, I'm going to acquire you on the 17th of October, right? You have to prepare a financial statement as at 17th of October and show all your income as at 17th of October, show your assets and liabilities and equity as at the 17th of October, all your cash flow as at the 17th of October as at the date of acquisition, right? You prepare. So this now, you don't wait until the end of the year. Maybe if let's say your year end is at 31st of December, you don't wait until 31st of December. You prepare your financial statement as at the date of acquisition, so that the parent company knows exactly how much retained earnings you have, how much owner's equity you have. Remember, the acquirer, or the acquirer, or the one who is going to acquire you needs to know, so that they will be able to bargain. They need to know how much your owner's equity is worth. Because remember, when I'm coming to buy a company, the owner's equity gives me an indication of how much your company is worth, right? Because assets less liability equals owner's equity. If I sell all my assets and I settle all my liabilities, whatever is left is what the company has, right? So every company, your owner's equity tells me how much your company is worth. So that is why it is very important that you prepare your financial statement as at the date of acquisition. So that already we know the date of acquisition, and therefore we know what is included, what is going to be included in going forward, and what is going to be excluded going forward. I don't know if this answers your question.
Yes, thank you.
Okay, cool. Any other question, guys? Very, very crucial. Without this, you will be confused along the way, because you would be like, what is going on here? So everything that you will see, every question we do is going to be, we are accounting for post-acquisition earnings. What happened after acquisition? What happened after acquisition? So if they tell us that the retained earnings is 110,000 at the date of acquisition, and right now retained earnings is 220,000, what comes into the consolidated financial statement is 220 minus 110, because that is what we have earned post acquisition. That is why we don't take into account the earnings that we came to meet. We didn't take part in earning those retained earnings. So it cannot be part of the consolidated financial statement. Remember, the consolidated financial statement should give an indication to the users of the financial statement of how the group has performed. And when did the group start? The group started when the acquirer or the parent came to acquire the subsidiary. So it is only that day going forward. It's only that time that you'll be able to show what performance of how much you have been able to earn. Whatever I came to meet, whatever retained income that I saw or I came to be when I acquired you, it's not mine. And it must therefore not take part of it mustn't be part of the consolidated financial statement. But of course, when the subsidiary is preparing its own financial statement, right? When a subsidiary is preparing its own financial statement, it must assume that there's no group. So it carries on business as usual. You understand? It carries on business as usual. It still continues as if no group has happened. When you look at the own financial statement of a subsidiary or a parent, they carry on as if no group has happened. It's only when you go to a consolidated financial statement that you realize that, oh, okay, so there's more. All right, so you acquired this on this date. Now, post acquisition, you got this income. Okay. Right, you are bigger from this date. But in the own financial statement of both the parent and the subsidiary, it is business as usual. Nothing has changed. They carry on as if no group has taken place. They carry on. Do you understand this? Does this make sense? And then also, so it is one of the reasons why we do what is called the elimination journal entry. That one that we say debit share capital, debit retained earnings, credit investments, and that. So this journal entry that we pass, in a sense, is telling us that, you know what, guys, start from scratch. Whatever retained earnings that you came to meet, reverse it. Take it out. Whatever share capital that you came to meet it, take it out. It's not yours. And then we go on to reverse intercompany transactions. What are intercompany transactions? Intercompany transactions are the transactions that the parent company is having with its subsidiary post-acquisition, right? Because they only became post-acquisition. So if there's a sale between them, it's like you are selling to yourself, because you are now one entity. You cannot sell to yourself. If I sell to my subsidiary, it's as if I'm selling to myself. It's not allowed. So the standard says reverse it. Reverse that journal. So any transaction that happened between a parent company and a subsidiary, or vice versa, it needs to be reversed. And that is what we call elimination journal entry. Eliminate it. Reverse it. So if, for example, there was a sale transaction, right, between a parent and a subsidiary, right? A sale transaction, right? What journal entry would the parent pass if the parent has sold stock to the subsidiary? Remember, before we prepare consolidated financial statement, the parent and the subsidiary is business as usual. They are passing journal entries, right, as if they are just having a transaction with an outside entity. You understand? It's only when we come to the consolidated financial statement that's when we start to do all this elimination and stuff, because we say we are preparing for a consolidated financial statement. So every transaction that is happening between a parent and a subsidiary, they are putting it in their individual books as if they are valid transactions. Then during consolidation, we eliminate it because we say it doesn't apply when we are preparing consolidated financial statement, but it applies when we are doing the individual financial statement of the parent and the subsidiary. So if I sell to my subsidiary, what journal entry will I pass as a parent? Let's say I'm a parent company. I sell to my subsidiary. What journal entry will I pass? I sell stock to my subsidiary. I sell it to them on credit. What journal entry will I pass? Anybody in the parents' books? I'm selling stock to my subsidiary. What journal entry will I pass? I'm selling on credit.
Yvonne?
Yes?
Would it not be would it not be credit inventory and debit accounts receivable?
Okay, so you are saying debit accounts receivable and credit inventory. Okay. Okay, all right. Whatever you say, I'll write it down. What journal entry would the subsidiary pass in their own books? So we've got the one for parent, and we say debit accounts receivable and credit inventory. What journal entry do you think the subsidiary will pass?
The inventory and creditors.
Sorry, they'll do what?
Debit their inventory.
Debit inventory, okay. And what would they credit?
They are creditors.
Credit accounts payable. Good.
Yes.
So let's assume this is right, even though technically it's not right, but let's assume it's right. It's not entirely wrong. It's like 60% correct. Okay. So you see, the parent has prepared debit accounts receivable, credit inventory. The subsidiary has said debit inventory, credit accounts payable, right? Because the parent said accounts receivable because they've sold something on credit, so they are waiting to collect the money. And also inventory has gone out, so they've credited inventory. Good, excellent. Subsidiary says, I've received inventory, I've received goods, I've bought goods, so debit inventory because an asset has increased. Then they credit accounts payable because what? I need to settle my debts, right? Excellent. Now, this transaction is valid in the individual books of both the parent and the subsidiary. But when we come to prepare the consolidated financial statement, we say, guys, no, we cannot sell to ourselves. Selling to ourselves means that how can you sell to your own self? So guys, let's eliminate it. So in the consolidated financial statement, then we what? When we are preparing the consolidated financial statement, we eliminate it through what? A pro forma journal entry. So what the big name pro forma means that these are just journal entries that we prepare to make adjustment to our financial statement in order for us to prepare consolidated financial statements. So in the consolidated financial statement, what do? We credit accounts receivable. So we are reversing the transaction. We are crediting the account receivable in the parent, and we are debiting accounts payable in the subsidiary. And so this is the pro forma journal entry for this transaction. So you see, it is very easy. It's logical. It makes sense. The principle is there. Whatever I've done in my books, whatever the parent the subsidiary have done in their books, it is valid as far as individual companies, our individual financial statements are concerned. But when we come to prepare consolidated financial statements, which is in addition to our own financial statement, we need to reverse it out. Because when we come to a consolidated financial statement or the group, we will be selling to one another, which is not allowed. You cannot sell to yourself. So we reverse this transaction. So whatever was a debit becomes a credit. Whatever was a debit becomes a credit. Whatever was a credit becomes a debit. You have reversed the transaction. So every pro forma journal entry is about this principle. What has the parent company done? What has the subsidiary done? Let me reverse it. Why didn't I touch the inventory? There were inventory on both of them, right? So the inventory, they cancel each other. It was a credit to inventory and a debit. It was a credit to inventory in the parent and a debit to inventory in the subsidiary. The inventory cancel each other, right? But even at that, if you want to be more correct, you can actually do that. You can actually second journal entry, debit inventory in parent and credit inventory in subsidiary. You have reversed it. When we go into more details, I'll show you the calculation. But what is important is the principle. What is important is the principle. So once you have reversed, so in consolidation, there are just two steps or maybe three steps. Join the balance sheet, the income statement, the statement of change in equity, join them together. Make adjustments or pro forma consolidation journal entries, and you are done. Whatever is left is your consolidated financial statements. Join balance sheet, join income statement, join statement of change in equity together. Join them together, parent and subsidiary. Then make adjustment. This adjustment is what is called the pro forma journal entries. Whatever results, the end result is a consolidated financial statement, because you've joined them together. You have eliminated whatever we don't want, whatever is a transaction between us, and therefore whatever is left is actually the consolidated consolidated financial statement. Does this make things clearer? So let's say
For them, there's thumbs up.
Okay, good. Let's do one. I know time is good. Let me do one. Let's say I have, as a parent, right? I'm a parent company. I've subletted part of my building to my subsidiary, right? So, so I'm a parent. I have an investment property, and I've subletted part of my building to my subsidiary, right? Then at the end of the day, at the year, I revalue this investment property by 100,000. That means it was 500,000. I revalued it to 600,000, right? So in the parent, what journal entry would they pass to fair value an investment property? In the parent's own financial statement, what would they say? Remember, they have fair valued their investment property by 100,000. They have moved it up from 500,000 to 600,000. What is the journal entry? Anybody? In the parent's own financial statement, they have an investment property, and that investment property is a building that they have rented to their subsidiary. At the end of the year, they revalue this property by 100,000. What is the journal entry that the parent company will pass in their own individual books or in their own financial statements? Not the consolidated, in their own financial statement. What journal entry will they pass? Remember, it is an investment property that they have fair valued. Anybody?
I think they will get their investment property because
it's investment property by 100,000. Good. What would they credit?
They will credit fair value. What was the other line again? I forgot this. The other.
Fair value adjustment.
Value adjustment.
Which goes there? Where does it go? Does it go to profit and loss or other comprehensive income?
You said investment property would go. Was it? Oh, sorry, I forgot. I can't remember if it's P&L. Profit and loss, ne? P&L.
Yes, good.
Yeah.
So good, excellent, 100%. Okay. So in the parent, thank you so much for that. So in the parent's own financial statement, they will say debit investment property 100,000, credit fair value adjustment 100,000. That is what the parent will pass because they are fair valued an investment property. And this transaction, remember, it is a valid transaction in the books, in the own books of the parent. But when we come to consolidated financial statements, right, this transaction here, remember, you as a parent, you have sublet a portion of your property to a subsidiary. So as far as the group is concerned, what is this property? Is this an investment property? What is this property now? You, the group, you are occupying it as a group. So you see, it's no longer an investment property. To the group, is what? It's owner-occupied property.
It's owner, yeah, yeah.
Yes.
So
in the pro forma consolidation journal entry, what do you have to do? You need to reverse this journal entry. So you need to say credit investment property 100,000 and debit fair value adjustment 100,000. This is the pro forma journal entry, and it carries about 5 marks because the principle is difficult to understand. So you see how easy it is. So you always think about what has the parent done? Then in the group perspective, what must I do? So the parent has passed a journal entry, debit investment property, credit fair value adjustment. But when we come to prepare the consolidated financial statement, this entry has to be reversed. Why? Because as far as the group is concerned, this is an owner-occupied property. It's no longer an investment because as a group, we are one entity and we are occupying a building. It is owner-occupied. It's no longer an investment property because we are now what? A group. So this journal entry that the parent has passed needs to be reversed. Does this make sense? Yes.
I think it makes perfect sense for me from an investment property, but from an inventory point, I'm not 100% certain. The reason for that is that the business I work for has a holding company, right? Yes. And we've got 4 subdivisions, which are subsidiaries to it. One of them being a manufacturer that sells to the public, and they also sell to their retail subdivision.
Yes.
Yeah. So meaning that they do make profit from us as the other subdivision, the subsidiary to the holding company.
Yes.
So now from an inventory point, the manufacturer would obviously declare their stock at cost, and whatever they sell to us, they would obviously credit that from their inventory.
Yeah.
But now, and we on our side would obviously have to debit, and our cost would be higher, meaning that they would have obviously made whatever percentage they would put a markup to when they sell to us as the retail. Yes. But now I don't understand when we do consolidations, consolidated statements, how will the inventory part from the consolidated statements, how will that be declared by the holding company? Because, will they just declare the profit part, or will they still do journal entries of debits and credits and somewhere recognize the profit made?
Yeah.
Between the two companies.
Thank you so much for that question. But I think what I'm happy about is that we are getting there, right? We are getting there. By the time, maybe let me give ourselves maybe 3 weeks from now, you will know everything. Right now, I think I'm going step by step, right? That's why certain journal entries I'll just assume is right and we carry on. But you will understand as we move along. Everything is in this. It's in this model. Sale of inventory. How are we treating it? On end income. How are we reversing it? Everything is there, but we're going step by step. So I don't want to jump the gun now. If I explain it, if I answer this question to you now, it's just going to bore some other people. It's going to be too complicated for other people. But so let's go step by step so that you get, by the time in the next 2 weeks or a week to come, you understand everything.
Okay.
You will. But so what will happen, just in summary, is that the amount of inventory that they sell to outside, right? That one is recognized. Remember, everything that we sell within ourselves it has to be removed, right? It has to be eliminated. But whatever we sell to outside party, has to be recognized, because that one we are selling outside the group, so that one is valid, right? And then also whatever is N. Remember, the subsidiary will have a markup, all right, first, and then based on the markup, they will sell to us. That markup is what is called an on-end income. That on-end income needs to be reversed. And even that, so we need to reverse the on-end income, we need to reverse the sale, and we need also to be able to account for the profit inside. Remember, whenever you have a closing stock, there is profit inside that closing stock, and I will explain to you when we get there. The fact that you have a closing stock means that there is a profit in there. So we will use that on closing stock to calculate the on-end profit. But you will get it. I promise you, it is not difficult. You will see. Yeah, but let's move slowly. Let's move slowly. Yeah. Any questions, guys? This is a brilliant question, and we would deal with that. I promise you. This start letter has got everything that you just asked. It's got everything. Is there any other question before we call it? So today, right, like I said, this facilitation thing is for you to understand principles, because it's very important. Accounting is not those sort of courses that you can just come in and say, okay, this is how it is done. It's not like mathematics where you just use a formula. It is based on principle. And I think that's why many people actually struggle, especially with management accounting, because they don't understand the principle. Like when it comes to variance, standard costing, whatever, it gets confused because, like, but once you understand the principle, that's why I said this is a very crucial time that you go back, whatever we've discussed, go and think about it. And when we come to class, ask me the question, why are we doing this? Why is this like this? Why am I accounting for this this way? Rather, bear the pain right now and ask the relevant questions so that then things become easy going forward. Because this thing that we are doing here, you take it in your third year, you take it in your fourth year. And if you want to go the C route and write your board, it's the same principle. Nothing will change. And it doesn't even get any harder. This is the hardest consolidation can get. What this on elimination of on-end inventory and do that is the hardest it can get. It can never get any difficult. It's as easy as this. So once you understand the principles, you understand why we do this main elimination general entry, debit share capital, debit, you understand. Then you understand why we eliminate this thing and the mechanics, the calculations to it. It's easy. The calculation is not that important. The principle is more important than the calculations. Believe me, it is. All right. So just once we have done with lectures here, just don't go and just rest. Go over the third letter. Make sure that you understand, because now every time we come, we go deeper. So when you go back and you are reading it, it should make sense to you now. Things must now make sense. Oh, this is why we do this. Oh, this is how we do this. Is why we are reversing this. Oh, this is investment profit. This is why we do it. Remember, we cannot cover everything within these 2 hours, but it is to cover the difficult aspect and the fundamentals, so that when you sit down on your own, you will be able to cover. Remember, we don't even have enough time to go through disclosure, but the disclosure is very easy. I mean, these days it's an open book exam. So if they say disclose property, plants, and equipment, just open to IS 40 and look at the disclosure requirement and just write it down. So I'm not going to spend my time going through a disclosure, but the difficult aspect, the one that confuses people, that is what we will tackle in class, so that things are easier. When you are reading, it makes sense. Right. Any question before we call it today?